Okay, let's look more in depth at something we covered in class a little bit regarding treasury stock. Let's look at some of the some entries that you would make for treasury stock. It says here the corporation reported the following stockholders' equity. Basically, what you have is December 31st in millions. This is what we had. We had common stock, additional paid-in capital. We had retained earnings. We had treasury stock. Notice we had a reduction in treasury stock from previous repurchases of treasury stock for a total of 2062. For right now, let's just close this because it's not really all that relevant right now. It says here that exceptional purchased treasury stock at a cost of 28 million. Then later, after this event, resold that treasury stock for 8 million. This stock happened to have a cost of 3 million. Notice in this problem, they're not asking you to calculate the average cost of this repurchase. So you repurchased 8 million, but it doesn't even tell you how many shares were repurchased. It just says 28 million here, and then it says that 8 million was resold, this much was bought. Notice the lack of quantity. So it's not asking you or requiring that you calculate the average cost. At this point, you're saying, hey, we got this much when we resold it, and this is what it was cost. This is what the cost of it was. So let's just make, it says record the purchases. Let's record the purchase of the stock, of the treasury stock. In other words, the retirement of the stock that's outstanding, the common stock that's outstanding. First of all, this is cash. You're buying stuff, it's going to cost you cash. There's 28 million. Please pay close attention to these millions, because if you put 28,000,000, you'll get this wrong. Got to pay attention. And when you credit cash, know that if cash goes down, in this case, you're buying treasury stock, so treasury stock goes up. That takes care of the first entry. Now let's look at the slightly more complex one, where now you're reselling. Okay, so you retired common stock, and you purchased it at 28 million. So this means that you've got treasury stock of 28 million. Notice that no common stock account is hit, even though you're buying common stock and taking it off the market. Notice that no common stock account is hit. This is important because, see, there's a tendency when you're making these entries to try to take common stock off the books. Common stock, you leave it on the books, you debit treasury stock, which lowers. You can see here in the previous balance at the old beginning of last December 31st, you notice you already had treasury stock. So don't lower existing common stock. But when you resell, that's going to give you cash. And you're going to get cash of 8 million. The cost of the treasury stock, where it says here the cost of the treasury stock is 3 million, is a credit to treasury stock. So that shows that before you had bought $28 million worth. This is 3 million of it going back out, and you no longer own it because you're reselling it to get some cash. And then the difference is very easy. The difference just goes in paid-in capital from treasury stock transactions. And it's just the difference. It's just the plug. So that gives you your entry for the resale of the treasury stock. Lastly, it asks you, hey, what's the effect of this? What's the overall effect of this transaction? Okay, did it decrease or increase stockholders' equity? Well, remember that the debit to stockholders' equity, just like it shows here, this is the amount when we started this whole business where we were at. You notice that this is going to lower stockholders' equity. When you buy, right, when you buy treasury stock, it's a debit to treasury stock, and it goes right here and lowers stockholders' equity. Keep in mind, all these are credit accounts. The common stock account, the additional paid-in capital account, the retained earnings, these have natural credit balances. This debit, you know, once you go past this period and you make a debit, this is going to lower stockholders' equity by 28 million. So we know it lowers it by 28 million, but you float back out, right? This decreases stockholders' equity. These two are going to increase stockholders' equity. This treasury stock transaction is going to increase it by 3. And then the other one here, paid-in capital from treasury stock transactions, that also increases stockholders' equity. So if you take the 28 million, notice this is not a stockholders' equity account. This lowers it by 28 million. Notice this is not a stockholders' equity account. These two are. This increases it by 8 million. If you take 28 minus 8, you get 20. And we're saying it decreased because 28 is a larger number than these two increases. That's how you work this problem. We covered it somewhat in class, but I wanted to go ahead and uh, cover it here in video. Be careful. When you make this middle transaction, there's a strong tendency to want to make this entry, the cost of the treasury stock. There's a strong temptation, since you're issuing stock, but remember, you're not just issuing new stock, you're issuing this old treasury stock. There's a strong tendency to make this common stock, 3 million. Don't. When you're doing treasury stock transactions, if you look carefully here, we're never hitting common stock. I hope that tip helps you.